Yeah, so just following on from what Gareth said, obviously, yeah, I am the CA in residence at the Ice House at the moment. So for anyone out there, that basically it means that we're on call if you've got any questions, anything you want to know about, like what's going on at the moment, how it impacts your business. We're just a resource that anyone that is associated with the Ice House can use. So I do encourage you to get in touch with the Ice House or get in touch with myself if you do want to use that, because it's a pretty cool opportunity, not only for me, but for all those businesses as well. But today we're going to run through, before I cut into it, just a little bit about my background. Obviously, as Gareth said, I started my own business 3 years ago, but prior to that, I had worked in accounting firms, and then I spent about 8 years working in various corporate and commercial roles. When I was at Spark, my role day in, day out, 40 plus hours a week, was nothing but forecasting for business, broadband and mobile. Weekly reforecasting, monthly reforecasting, budgeting, all that stuff. And also when I was at IAG, I did exactly the same for NZI Insurance. So forecasting's in my blood. It's something that I believe is incredibly important, not only in the situation we're going through now, but just for business in general. And I think with all the measures that are getting rolled out and all the help that is going to be available for businesses, a lot of what is and isn't approved is going to fall back on their ability to forecast. So this topic is very, very close to my heart. Let's jump right in. I will share my screen. Please, I'm hoping you guys can tell me if what I'm sharing isn't working or you can't see anything. But so before we jump in, can I check that you guys can see my slideshow? You guys have got it? Perfect. All right. So what I want to jump into is just what I'm covering today. And so what I did with this was I made sure it's on the back of, just make sure I got my timer going. It's on the back of conversations I've had with a lot of either new clients of mine or clients that I work with regularly. And it's questions that I ask them when I am preparing forecasts and budgets for them. And quite often it's a knowledge gap that I have probably made the mistake of assuming that everyone knows. So that's what's causing the basis of the information I'm presenting today. It's also when I've sat down to work with people to start applying for some of the business loans that are available, like the government-backed business loan, or what's just been announced, that tax loss carry back scheme. Just trying to get my head around that still. Tax loss carry back scheme, all of that is going to be, obviously the basis of it is going to be forecasting. So when I am talking to them, quite often I'm finding that they're unaware of some of these really critical pieces of knowledge that they need to know around their business. So if they had known this stuff, it would mean that it makes the process that I'm working with them much more smooth and much more effective. And also if they're presenting or preparing their own forecasts, it also makes it much easier for them as well. The first thing I'm going to cover off is just the driver-based cash versus profit forecasting. So fundamentally, what is the difference between a cash forecast and a profit forecast? Sounds super simple, but quite often it's something that's very easily overlooked. I'm going to run through what you need to know when you are preparing a forecast. So I want you to, in that situation, it's going to be you imagining you're sitting down with your advisor or you're sitting down to prepare your own forecast. What information should you have either in your head or written down on your notes so that you can make sure you're maximizing that forecast and getting the best out of it? Then I've just got a really simple, basic run through just of what a driver-based forecast looks like and how you can hopefully apply it to your business. Just very quickly, I am covering the basics. I am just trying to keep it pretty simple because ultimately it's the simple stuff that's done really, really well that can make all the difference when it comes to forecasting. So it's nothing too advanced. And I do apologize if anyone is currently already working with their advisor or they're already doing their own forecasting if they think that this probably isn't relevant to them. Hopefully there are some nuggets in here that you can use that will help you when you are preparing it. But that's what I'm hoping to achieve today. So let's jump into it. So the first thing, obviously, when we talk about a cash forecast versus a profit forecast, I'm going to talk about here what's included in a profit forecast. And this is probably one of the main things that I see, which really causes a lot of confusion for people when we're talking about cash versus profit, because they're not necessarily the same thing. If you think about a profit forecast, obviously, as it says right there, you're focusing on your profit and loss, right? But that also includes accounting adjustments, such as non-cash items like depreciation or home office. But one of the main things that it includes with a profit forecast is if you're selling goods, like selling inventory or cost of goods sold. Quite often, if you've got an inventory management system, if you're seeing sales of those goods, quite often the cost of goods is just reflective only of the sales that you've made in that month, and that's how you obviously get your gross margin. but that's not necessarily the cash that's come out of your business. It's an expense for tax purposes, but it's not cash that's gone out for that month. And that can be quite confusing to many people. So a profit forecast will include a lot of non-cash items. It also doesn't include items such as your drawings, if you're owners and you're taking drawings, or taxes, loan repayments, or any fixed asset purchases. In many cases, it's those things there that are actually the biggest drains on people's cash flow. So when we're just looking at a profit forecast, generally we're just trying to work out what your profit's going to be so we can look at your tax and what those implications are. It's not necessarily focused just on cash. So if we move to the cash forecast, not to be, please don't confuse this with a statement of cash flows. A statement of cash flows forecast is quite an advanced form of forecasting. What I'm talking about here is essentially it's just forecasting the money coming in and all the money going out. It's just a cash forecast, but set up in the same way as you would do a profit one. And really, as it says up there, it's just all about the money in and out of your bank. A cash forecast looks at your bank accounts, what's going in, what's going out. Doesn't matter what it's going out for, it's just what's in, what's out. And that's in these moments, that's probably one of the most important elements we need to be worried about, especially because we don't know when we're going to be back working again. So knowing what that cash is going to look like in our bank account is probably one of the most important elements of getting through. So you can see what it includes. It includes all your income, expenses, fixed asset, loan payments, taxes, drawings. Profit isn't the main focus. It's obviously important because we want to know, but rather than profit, it's more your operating income, because we're trying to then work out how much cash your business is generating from its operating activity. But the key thing to understand with the cash forecast is that it is purely just cash. Doesn't include any adjustments that have been made in the background by accountants, home office depreciation, all that, amortization, all of that stuff. And it doesn't include, it's not really reflective of your gross margin per se if you're selling stock, because the only thing that matters is when does the cash leave your bank account to purchase that stock. That's all that counts. So very, very different in that element to a profit forecast. So what do you need to know when forecasting? Before we jump into that, just to clarify, what we've done now is we've just covered the fundamental differences between a cash forecast and a profit forecast. You're going to be doing them under two very different circumstances. So we're doing a cash forecast. Now, what do you need to know when you're forecasting that? What I want you to do right now is I want you to imagine that you are sitting down with your advisor, or you're sitting down to do your forecast yourself. Obviously, you've either got to, you want to apply for the government-backed loan, or you do want to apply for the tax loss carryback scheme, or you just want to understand your own forecast and how your business is going to survive over the next 12 weeks. You're sitting down to do it, right? So obviously clearly know that you're going to be doing a cash forecast, which is the best thing for this situation. Now, right now, what I want to run through is the knowledge and the understanding of your revenue drivers, your expense types, and all your balance sheet movements that will significantly increase the usefulness and the viability of your forecast, all right? So it's all about making sure that when you are sitting with your advisor, you've got the knowledge that they need, so when they ask you those questions, you can answer them in a succinct and clear way, so that that means they can jump in and they can spend all their time looking at that future view, rather than spending their time working with you, trying to generate and get all the information together so they can start doing that. Because the more time you can spend looking ahead, planning, scenario planning, testing, looking at what you can do, what your options are, the more time you can do that, the better you're going to be, as opposed to spending all your time at the beginning just trying to get things started. So what you need to know when forecasting is the information that's going to allow you that when you do spend your time forecasting, it's going to be your time is going to be mainly spent looking out here and trying to determine what it is that you actually want to do. So the first thing, when you're sitting down with your advisor, the first thing you want to know is, oopsie, we've gone too far. The first thing you want to know is about your revenue, okay? So you want to ensure, firstly, obviously revenue is incredibly important, right? And so you want to understand where your cash is coming from. Now, I encourage, it doesn't matter if you're doing a cash forecast for any of the, the government's help that's coming out at the moment, or you're doing it to try and get through the next 12 weeks. Having this knowledge is so incredibly crucial to your business, not only from that forecasting point of view, but if you're looking to try and make some strategic decisions, where you're trying to plan for what you want to do in the next 1 year, 2 year, 3 years, if you're doing any form of business planning, having this knowledge is going to be incredibly helpful. So even if you don't use it for a forecast, just testing yourself now or even after this to sit down with a pen and paper and see if you can answer these questions would be very, very useful. So when it comes to revenue channels, we want to know, where does your revenue come from? You know, are you online? Are you online? Do you have a bricks and mortar retail store? Are you wholesale? Are you retail? So are you just direct? Are you business to business? You know, so where is it that your money is coming from? What channel or mix of channels is generating your money? Then we look at revenue streams, right? And how many so when I've put here, how many revenue streams do you have, and can you add more? Think about it this way. Is 80% of your income coming from only 20% of your base, right? If you think about that way, so how many different sources of income do you have? How many streams are coming into your business? Now, another way to think about this as well is, are you industry specific? Do you have one specific industry that you look after? Like, for instance, if you think about an accounting firm right now that solely has revenue streams that are coming from clients that are in the hospitality or tourism business, it's a very different outlook to if you have a revenue stream that's solely from clients that are online based and online tech based. So really, really interesting, really, really important that you understand those different revenue streams. Because are you evenly distributed across industries? So being able to answer those questions will really help when it comes to forecasting, because if you think about the environment and how much it's changing, being able to understand if something changes, if we move into a level 3 or we move into a level 3 plus, whatever level 3 is, it might dictate who you can and who you can't sell to, or who can and can't buy off of you. But understanding who that is will be incredibly important. We talk about product or service split. So some people just sell one product or one service, but many people don't. Like, for instance, going back to an accounting firm, we might have compliance, and then we might have advisory and business planning, which is a different service. Each one, some of them might be high volume, low margin. Others might be, there's less of them, so the volume's much lower, but the margin's much higher. So understanding of your products, how they're split like that. So it's a very important understanding. Because when you think about the revenue channels, your revenue streams, and your product and service split, they're all interlayered, right? You might have various revenue streams, some of which are coming through different channels. One channel might have certain streams only, or they might be across all your different revenue streams. You might have one product that is pretty much solely digital only. You might have another service that is face-to-face via a retail store or something like that. So understanding the relationships between all the different ways that you're receiving your revenue will put you in really, really good stead for when you sit down to do your forecast. And then underpinning all of that is ultimately, at the end of the day, if you strip everything back and think about our revenue, we get it from 2 ways, right? We get it from either selling stuff, lots of it, at a low margin, so we're generally volume. Or in a perfect world, you sell it at a high margin, you make heaps of money. Or we sell a little bit of stuff at a high margin. So we're either value, high margin, low volume, or we tend to be volume, high volume, lower margin. But ultimately, you either sell stuff, so it's either the number of things you sell, or it's what the price that you sell them for. Generally, it's the only way that you're going to make money. So just understanding that relationship between value and volume for you. Have you got high margins that you can maybe move down to try and move things forward if they're stagnating at the moment? Or if you are volume based, can you pick that back up? What revenue channels can you sell them through? Which ones are performing better than the other? If we do move, say, into level 3, what does that mean for your different revenue streams and the different products and everything that you sell? So revenue, obviously, as you can see, is incredibly important. It's not about understanding, okay, you're making 10 grand a month, 20 grand a month. It's about understanding what is driving that 20 grand a month. And if something changes from one month to the next, let's say your revenue goes from 20 grand to 30 grand or goes from 20 grand to 10 grand, what is it that caused that revenue to drop? So it's a really important thing to understand. So you can imagine if you're sitting with your advisor about to prepare a forecast for the tax loss carryback scheme, or to get a loan, because to get that government backed loan, we still need to go through the same channels, and the banks still need to do their same checks that they normally would. You imagine if you've got this understanding here, how much more of a better position you're in when you're preparing that forecast. We then move on to expenses. Now, I mean, everyone knows expenses. The key things I want to run through with this are your direct costs versus your overheads, because at the moment, obviously, your direct costs generally will tend to stop when the income earning activity stops. But a lot of people forget when they're doing their forecast, they start looking at the revenue. Because the first thing we're going to look at is our top line, but we sometimes forget that relationship between the revenue and our direct costs. And the one thing I do want to make really clear is that when you are doing a forecast, if you can somehow build it in so that if your revenue is changing to different scenarios, that those direct costs related to that revenue are also changing as well, because that's what allows you to scenario plan. Because if you've sort of just got your direct costs unrelated to your revenue, you're kind of just preparing a budget. So yeah, really important to understand which costs are directly related to that revenue going up or down. The other part when it comes to your overheads is just understanding, making sure you are super clear on that P&L line by line, which ones are fixed, which ones are variable. If they're variable, how many you can move and how much you can move them by. And if a overhead is fixed, what your options are to, if any, that you've got to move it. Now, at the moment, one of the big ones with fixed overheads and many people are feeling the pain on is rent. So what options, if any, are there for that, that overhead? But for many people, there's nothing much we can do about it. Now, when you're, once again, another question that your advisor will ask you, or something else you need to be really aware of when you are doing your forecast, is debt, right? And it's not so much just knowing what are your monthly loan repayments, it's also knowing the information behind it. How long's the term? What's the interest rate? Knowing all that information is really important, because if you've got significantly leveraged, moving on to interest only or moving on to a repayment holiday, might is something that it could be a very important tool in your arsenal for getting through a cash crisis over the next month or however long this is going to be. So yeah, it's not just knowing your debt, it's knowing the details behind it. I'm quite surprised. I've seen people that have got debt, but they're not quite sure how much they've actually got. They don't really know what the payments are. So when it comes to tax, we just want to know, obviously, when it's due and how much it is. So yeah, be really, really clear on that. I mean, that's something to be clear on anyway, and I always encourage people to understand that. But when it comes time to doing this, that's something else we need to be aware of as a drain on your cash. And capex, what you need to know, what you need to buy and when. Obviously, if you've got something that you need to buy in the next month or so, or couple of months, especially if it's a significant item, it's something that's incredibly important, and we need to be aware of it when we are preparing a forecast. And something about at the bottom there, drawings. How much can your business afford, and how much are you taking? It's one of the most simplest aspects of accounting that I think, and I tend to have seen it, and I think many people do. We overlook how important and how much of a drain drawings can be on your business if you're obviously you're a shareholder and you're just taking drawings rather than a salary. And I think a lot of the problem is when we have like an $800 transaction here, another one there, like those transactions in isolation, we can handle them. But when you sort of add them all up, they very, very quickly can become quite a drain on your cash flow. I'm sure many of you have heard about the business owner that has an awful lot of profit, but no money in the bank at all. And quite often it tends to be these items here that are causing big drains and can be big handbrakes on people's cash flow. So we're putting it all into action. So what does it mean by putting it all into action? So we're at the point now where you've sat down with your advisor. You've got a really clear understanding of your revenue drivers, your channels, your revenue streams, your product mix, who your customers are. And then you're very clear on your expenses, what expenses are related to your revenue, what are your overheads that are fixed, what can you move. So you're sitting down and you're armed with some really important knowledge as to what the fundamental drivers of your business are, what it is that's impacting your cash flow, what it is that you can control, and what it is that you can't control. And what I want to do now is, I can see we've got about 10 minutes, maybe a little bit less, is I want to show you an example. Now, normally there's so many different forecasting software tools out there, and they're really, really good. Like you hear about Futurely or Spotlight Reporting are two of the more popular ones, but there's plenty of others out there. But for this example, I've just used simple old Excel. And the reason I've used Excel is because I'm not necessarily here to provide you with a forecasting template or do a forecast for you. I just want to show Excel is really easy for me to show you all those fundamental aspects I've talked about and how they all tie into each other and why each one is so important. So I pulled together a bit of a demo company, and I want to run through how we do the forecast, what it all looks like, the different channels, the different streams, and just to show you some of the things that as an accountant and an advisor, we're going to be thinking about, we're going to be asking you when we are preparing one. So please let me know if you can see this. I'm assuming you can now see a Excel spreadsheet. Yep. Now, what we want to look at here is, please, if you are someone that is a bit worried about Excel, please don't get turned off. Like I said, this is just a basic demonstration of how it all works together. And as an advisor or an accountant, what we're going to be running through when we are preparing something like this, whether it is in Excel in a much more advanced state than this, or we are using Futurely or Spot or some form of software. Fundamentally, we're running through the same thing. So this demo company here, or this example company, this is the units that they sell each month, and they sell them. These are their two revenue channels. They've got a retail line and they've got an online store. So their online store sells a lot of product each month, and their retail store sells a lot, not as much. And then you can see down here the average revenue that they're getting per unit. In retail, they're getting $50, and online they're getting 35. So already we're understanding that we've got our two revenue channels, and we also not so much our revenue streams at this point, but we understand that we're selling lower value items online, and we tend to sell our higher value items in our retail store. And what that means is that if we scroll up here, we've got some sales that come through. So all of this information, when we're preparing a forecast, we run it off actual data. Now, whether that's come from Xero or whether it comes from SMYD or anything else, we tend to take your actual data year to date, and then we're forecasting each month forward. So we're assuming that up till March, this is all their actual trading data. And this is all the sales that have come through based off of selling 65 units at $50 a pop and 350 units at $35. That's obviously what generated their sales. Now, in this instance, this person here is this business like any others. We got hit by COVID-19. And so in March, our retail and our online sales absolutely died. And so we're in a point now where we don't know when we can open back up again, which is why for the future, we're seeing absolutely forecasted sales of nil. The first thing we want to understand is what on earth that is going to look like to our cash. So we've scrolled down here and we've got they're going to get their rentals, their wage subsidy, which is great because it's just a single shareholder in the business, no employees. We go down past their P&L, and what we do is we have got their expenses. So we've got their operating expenses down here. We've got a good idea of which of our expenses we can flex, which ones we can stop, which ones have to go through. So we can see this person here sees their advisor is incredibly important, because right now their advisor is one of the most important partners in their job. So they're in their role, so they're continuing on that expense. They can also see that their light, power and heating, that just has to keep moving. And then we've got their rent as well. That's not fixed either. So that is fixed, so they can't do much about that. So we kind of put down all the expenses that we know have to go forward. So like I said, whether that's Excel, whether it's a whether it's a software program, we want to know which expenses are sunk, are fixed. We can't do anything about them. Subscriptions, telephone and internet, they absolutely there's nothing we can do about them. They're staying the same. And then we get down to their balance sheet items. Like I said, this once again is please don't see this as an advanced form of forecasting. It is literally just a very, very basic template that can be used just to try and demonstrate what I'm talking about. Because in this instance, this person also has a car loan, they've got a business loan, and they've been taking drawings of $10,000 a month. So at this point, the first thing we've looked at is our expenses, because they're generally the easiest for us to forecast out. And then what we go down to here is we look at our opening cash for the start of the month. So at the end of March, we had $1,800 in our account before the wheels fell off. And then that was our opening cash for the month. At that point in April, that was our cash movements, and that's our closing cash. So we can see at the moment, unfortunately, this company is going to be insolvent pretty damn quick, based off the current trajectory with the current levels of cash that they've got. It's not looking great for them, because if it continues the way it is, they're going to run out of cash pretty quick. So when we're doing a forecast, that's our first point of call. What's our baseline? So we can see that there is our baseline, and it's not a great view. So we want to forecast out. If we're preparing, like I said, we're applying for either the tax loss carryback scheme or the government-backed loan, or even if we just like, okay, how am I going to get through the next 12 weeks? What we want to do now is we want to then look at, well, let's assume that we're going back. We want to do scenario testing. So we want to assume that we're going back, say, to work in May. Let's say the announcement comes out in now, or even it probably is right now, or on Monday, that we can start working again. So they can see that their online arm, they can start picking sales back up. So they think they can probably sell another 25 units through there, another 125 units in June, and then they could possibly get back up to where they were of 350 units in July. What does that do? So we can see that's their sales there. What does that do to their closing cash? We can see it's still not quite enough. So we're like, okay, well, let's see what we can do in terms of trimming. At the moment, a big drain on that is obviously their drawing. So can they go to interest only on their loans? Can they go on loan repayment holiday? Can they pull back right back on their level of drawings? Let's say they think they can get it right down to $5,000 a month. Right, so we pull the $5,000 a month through for a couple of months, and we can see there that's still not quite getting enough. So that plan still hasn't worked. What about on these two loans? If we go down to say interest only, which we've done here, we can drop it from $875 down to $350, which is great. And then in this business loan, we might be able to drop that one down to $50 as well. So we pull that through, and we can see that it's still not having the desired effect that we need on. If this business can't start trading, like many others, they're not going to be able to be sold. They're going to run out of money pretty quick. So we've worked through what we can control, which is obviously that drawings amount. We've gone interest only on these loans for a couple of months. If we look at our expenses and we assume in May we're going to start back up, so these are our variable costs, such as our motor vehicles and our office expenses. Realistically, this is what we think they're going to be, but we might be able to trim a little bit off of these. But ultimately, it's going to come back to how quickly we can trade. So we know that in May, if we can assume that we're going to start trading back again in May, we think that maybe we can push that back up to 150 units that they're going to sell. We can push that up to say 250 and getting that back up to 450. We might be able to open up some form of retails where we can get that back up to 20, up to 40, and then slowly increase our sales. If we think that that's what we can do, what is that going to look like to our cash? So you can see here that all of a sudden, basically what that means is they're going to stay solvent. So what that becomes is almost their best case scenario. So if they believe that based off of the announcements that are coming out and the changes in the alert levels for this business here, if they think that they can get back to these number of units that they're selling through this channel at that price, with some of the other cutbacks they've done in their costs down here, fundamentally, we think that we can actually keep the business trading and stop them from running out of cash. If it got to a point where, say, we didn't think that could grow, realistically, it was only going to be 50, maybe 50, and then potentially in July, that's when we would look to go to a business loan, government-backed business loan, to inject some cash into the business, and something like this is going to form the basis of applying for that business loan. So you can see that, like I said, so we could spend the next hour running through something like this. But what I want to do now is just quickly finish up because we are getting into, I'm running out of time. But the whole point, just finishing up on that the whole point of showing you that Excel forecast was not to show you that's how you do one, but to show you the fundamental thought that goes into it, and how if you have that knowledge of your revenue drivers and also your expenses and how they relate to that revenue, and you also understand those cash drains on your balance sheet, being able to sit down and do a really, really simple forecast like that can actually give you a great idea of what's happening with your overall cash. So in summary, if we look at this, like knowing your numbers, it comes down to knowing your drivers. That's the most important part. For me, forecasting, it's, as it says there, it's proactively planning how you can react to an unknown environment. As things change, as new announcements come out, what does that mean and what impact does that have on our business? What can we do? We plug those numbers in, we see what it's going to look like. We can then react more proactively rather than feeling like we're just getting pushed around. Understanding the difference between a profit and a cash forecast obviously is incredibly important. Talking about what's included in a cash flow forecast. So really understanding that it is just the money that's coming in and the money that's going out. And then showing you an Excel forecast in action, very, very, very basic. The whole point of that was just to show you how it all works.